In doing so, again, we are going to take this to another level. So let me bring this up. All right. And so the first thing that we're going to look at is the history. And this is the IRS history of taxes, right? And so we're going to start at the beginning, right? 1765 to 1776. And we're going to walk through this timeline. I'm going to go in certain areas, I'm going to go briefly through it. In certain areas, we're going to stay on it because I want you to understand taxes, how they were developed, why they were developed. And we're getting it directly from the mouth of the IRS. Okay. So I really want you to pay attention to this because as I go into, as I go further into this conversation, you're definitely going to want that information. So, taxation without representation was the seed of American Revolution. Colonists rebelled against Britain's punitive taxes because they had no voice in Parliament. On 6/4/1776, the Declaration of Independence, or 7/4/1776, excuse me, the Declaration of Independence severed ties with England. The Revolutionary War ended in 1783 and a new nation was born. So now in 1776, they declared independence, right? The independence from what? Taxation without representation. That was what they were saying they were breaking from. They broke from a lot of other things. But we know that the sales pitch for that war was taxation without representation, right? That was the main reason, quote unquote, right? Now, since that is a fact, right? Therefore, what took place? There wasn't any tax at that time in the United States. I want you to be clear, right? So then what happened was the evolution of taxation came into being 1787 to 1789, right? So approximately what, 10 years, 1776 to 1787, or 10 to 11 years, right? Is that correct? Let me make sure that's right. Yeah, 10, about 10 to 11 years, right? On in 2/21/1787, Congress approved a constitutional convention to advise the Articles of Confederation. Okay, so they were advising the Articles of Confederation, right? Now, the Congress shall have the power to lay and collect taxes, duties, imposts, and excesses to pay the debts and provide for the common defense and general welfare of the United States. So they did what? They revised the Articles of Confederation in order to allow taxation. Because remember, the reason they broke away from England was because they were being taxed. So they had to revise the Articles of Confederation so now the United States could tax. But they're talking about taxation with what? Representation, meaning you have the right to vote, right? Quote unquote, that you have representatives, right? But at this time, right, the slaves didn't have the right to vote, women didn't have the right to vote, right? So it was the aristocracy that really had the right to vote. And so the aristocracy are the ones that actually were able to have representation, but nobody else really had representation at this time. So I want you to be clear, it was still taxation without representation, but they figured that the country needed taxes, right? All right, so I want us to be clear on that, right? So then came the Risky Rebellion. In 1794 saw the first outright challenge to U.S. government revenue laws when a federal court summoned 75 distillers in Western Pennsylvania to appear in court and explain why they shouldn't be arrested for whiskey tax evasion. I want you to notice this key word here. I want you to notice this word evasion. Write that word down because it's very important. And we're going to get into that. I want you to notice the word evasion. Okay. This is super important. And if you can put a message in the chat, I would greatly appreciate it. So I know that the chat is working. So if anybody has a question and that you all can hear me clearly, see me clearly, and everything is clear, if you could just drop that into a Facebook chat, Instagram chat, uh, Twitch chat, or YouTube chat, anywhere, I greatly appreciate it as we continue. And then the other thing is share this with everyone you know. Okay. Share this with everyone you know. Okay, great. Excellent. Thank you so much. Thank you so much, April. We appreciate that. Thank you so much. So basically every share this with everyone you know, because you want to make sure that you're able to see this as well, right? You want them to see it as well. You want them to know about it, and you want to be able to help people as well. Okay. So this is going to be very important. So we want to get the history first, and then we're going to go off into some other deep areas. Okay. So 1794 saw the first outright challenge. So we're seeing a battle here, right, for whiskey tax evasion. And I want this word evasion, make sure you write that word down. The Whiskey Rebellion set up a clash between citizens and federal officers. The federal government prevailed, but at the cost of 1.5 million to American taxpayers. So they had another reason to do what? Boost taxes on the American taxpayer, right? Now, the war, notice war again, right? To pay for the War of 1812, Congress passed new internal taxes on refined sugar, carriages, distillers, and auction sales, and reinstated the commissioner of the revenue to collect them. On August 24th, 1814, the British burned the Treasury building in Washington, D.C. On 12/23/1817, Congress repealed these and all remaining internal taxes and abolished the position of the commissioner of the revenue and all offices to collect them, right? This is not the IRS yet. This is just the Treasury collecting, right? They're just collecting taxes. There's internal revenue, but it's not the internal revenue service that we have today, the IRS. In 1836 to 1842, the Treasury gets a new home. Construction began on a new Treasury building in 1836. The first segment opened in 1842. 1862, Civil War expenses. On July 1st, 1862, President Lincoln signed the second revenue measure of the Civil War into law. This law levied internal taxes and established a permanent internal tax system. So now there's an internal tax system, right? Congress established the Office of the Commissioner of Internal Revenue under the Department of the Treasury, right? So now we're seeing an internal revenue under the Department of Treasury. On 7/17/1862, George S. Boutwell became its first commissioner. So the commission was shut down, then it was brought back, right? And now we have an internal revenue, right? Internal revenue. Now, in 1863 to 1864, property seizures and tax refunds. In its first year, 1863, the Office of the Commissioner of Internal Revenue collected $39.1 million, right? This is like what Robin Hood was fighting. You understand what I'm saying? This is like when you see Robin Hood, this is what he was battling right here, okay? So in its first year, 1863, the Office of the Commissioner of Internal Revenue collected $39.1 million. The Revenue Act of 630/1864 authorized the Commissioner of Internal Revenue to compromise all suits relating to internal revenue, to abate outstanding assessments, and to refund taxes subject to current regulations, right? So now we got a tax refund, right? Which we're going to talk about. State of the art technology. In the second month of 1867, the Secretary of Treasury adopted a hydrometer to establish a uniform system to inspect and gauge alcoholic spirits subject to tax, right? So now we're at the point where they're talking about, we saw with the winery and the distillery, they were going to arrest them for evading taxes. Now they got a state of the art technology in order to inspect and gauge alcoholic spirits subject to tax, right? So now they found a way to tax it, right? So the March 1, 1867 Revenue Act authorized the Secretary of Treasury to adopt, procure, and prescribe these and other weighing and gauging instruments to prevent and detect fraud by spirit distillers, right? So that's all it was about. Everything is about making sure that the government can get its money, Be clear on that. I want you to understand that. Now, personal privacy. Representative, later President James Garfield of Ohio, spearheaded an effort to make tax information private. On 4/5/1870, IRS Commissioner Delano forbade tax assessors from furnishing lists of taxpayers for publication. On 7/14/1870, Congress passed a Revenue Act stating no collector shall permit to be published in any manner such income returns or any part thereof except such general statistics, right? Now, this is a law. These are laws that I'm reading to you now, right? Next, first federal income tax in 1913. What else was created in 1913? Right? We talked about that last night. So in 1913, the first federal income tax, right? Because the Federal Reserve was also created at the same time. So now there's a federal income tax on top of a what? State income tax. So on February 25th, 1913, the 16th Amendment officially became part of the Constitution, right? The 16th Amendment, granting Congress constitutional authority to levy taxes on corporate and individual income. The Bureau of Internal Revenue established a personal income tax division and correspondence unit to answer a flood of questions about its enforcement, and a special division within General Counsel to prepare opinions interpreting internal revenue laws. Now everything is being set up as we know it today. 1913, mark that date. Form 1040. This is the form that the average person fills out. When we get into protect the portion, the workshop that's entitled Protect Your Family, when we get to that workshop, what's going to happen is we're going to be talking about another form that we should be using, not the 1040, but the 1041. And we're going to talk about that when we talk about protecting your family. But the average person is only available to you is the 1040. You have to actually order or request the 1041 document. So if you go into any library or you talk to any tax accountant or whatever, they're always going to hit you with the 1040, right? But you don't want to fill out a 1040. And we'll talk about that more in depth later. On 1/5/1914, the Treasury Department unveiled the 4-page form, including instructions for the new income tax. The form was numbered 1040 in the ordinary stream of numbering forms in sequential order. In the first year, no money was to be returned with the forms. Instead, each taxpayer's calculations were verified by field agents who sent out bills on the 1st of June. Tax payments were due by the 30th. Right? So tax payments were due by the 30th. Public awareness. In 1917, the Internal Revenue Bureau launched a special nationwide public education program to help citizens understand the new tax burden, because it was. Because remember, the taxes at first were supposed to be for corporations, but now they had an individual tax. And they used wars in order to promote people giving to the taxes, right? So anytime there's a bad situation or anything like that, they're going to always harp upon the people in order to get them to tax them higher rates, right? In 1970, the Internal Revenue Bureau launched a special nationwide public education program to help citizens understand the new tax burden. The campaign tried to popularize war taxes by emphasizing the needs of the country and appealing to national pride and patriotism. So the marketing plan, right, the marketing strategy was to popularize war taxes. How? Through commercials that did what? Emphasize the needs and programs, of course, to emphasize the needs of the country and appealing to national pride and patriotism. Right? 4-Minute Man fanned out across the nation, preaching the importance of paying taxes promptly and fully. So this is how they were marketing at that time. I want you to understand. So you're always looking for, when information is coming to you, You're looking for the sales pitch, because it's always a sales pitch to get you to do something. Whether it's a television program, whether it's, somebody knocking door to door, whatever it is, it's always a sales pitch to get you to do, for more money for the government, right? That is the program. And once you understand that, again, you can now make conscious choices on how you're going to move forward. Prohibition. Congress passed the National Prohibition Enforcement Act on 10/27/1919. It prohibited the manufacture, sale, and use of intoxicating beverages. It also designated the Bureau of Internal Revenue as the enforcement agency. So Internal Revenue, right, the BIR in this case, as the enforcement agency. The Bureau hired and trained hundreds of prohibition agents to enforce the law and created a new intelligence unit to uncover corrupt prohibition agents and bootleggers. Hence, when you watch the movie Untouchables, that's what this is about, right? But why? Because they couldn't tax it the way they wanted to, right? It's all about taxes, everything. It don't have nothing to do with law and helping people and all of that. No, it's all about money. Follow the money, you're going to understand the program. So Bureau of Internal Revenue gets new home. On 6/1/1930, the main section of the new Internal Revenue building opened, 16 months ahead of schedule, and with a total construction cost of just over $6 million. In addition to state-of-the-art fire alarm system, it contained 1,400 telephones and a synchronized system of 861 clocks, the largest system of its kind at the time. Now, what's the historical reference to 1930? 1930 is a super important date, because 1930 represents the Great Depression. It represents the stock market crash. But if you notice, the IR or the BIR, right? The Bureau of Internal Revenue, what happened? They actually were able to take $6 million and establish a building during the Great Depression and the stock market crash, right? Now, Al Capone, 1931. Al Capone, American gangster Alfonso Al Capone, attained fame during Prohibition by racking in millions of dollars through bootlegging and other illicit activities. In 1931, an IRS intelligence unit investigation led to his indictment on federal income tax evasion. I want you to notice this word. That's the second time it's shown up, right? Right. Make sure you got that word down. Evasion. It's a very important word. Indictment on federal income tax evasion and violations of the Volstead Act. He pled guilty, was convicted, and sentenced to 10 to 11 years in federal prison. A $50,000 fine and ordered to pay $250,000 plus interest on back taxes, which we know he didn't get. He died in jail, right? Payroll withholding. On August 14th, 1935, I want you to write this down. Payroll withholding. This is important. It's going to be important for you to understand this as we delve into this conversation tonight. Okay. So make sure you've got that, you've written it down, or you got it locked into your mind for real, because this is big, right? You need to be sharing this on your pages and sharing it with everybody you know. If you came in, welcome to the call. But I want you to definitely be clear on this portion, okay? So, payroll withholding. On 8/14/1935, Franklin D. Roosevelt signed the Social Security Act. The Social Security Act, right? Employees originally paid 1% of the first $3,000 of their salaries to finance the benefits. The law required a new system of tax withholding, which the Bureau of Internal Revenue had to collect and turn over to the Social Security Trust Fund. I want you to notice this word, trust fund. When we get into protecting your family, we're going to get deep into trust. So you're going to understand what this really is. right? Trusts are developed for families and family wealth. So the Bureau of Internal Revenue had to collect and turn over to the Social Security Trust Fund. It also created an unemployment compensation program and laid the foundation for modern payroll withholding. So it laid the foundation of them taking money out of your check so that they can invest your money instead of you. That's what this did, right? It used to be employees originally paid 1% of the first $3,000 of their salaries to finance the benefit, right? So that would be 1% of $3,000 is $30. How much is your, and that ain't every week, right? So how much is your tax every week or every time you get paid, right? Now, victory tax. The Roosevelt administration hoped to pay for at least half the cost of World War II by increased taxation. The 1942 Revenue Act sharply increased most existing taxes, introduced the victory tax, a 5% surcharge on all net income over $624 with a post-war credit, lowered exemptions, and began provisions for medical and dental expenses and investors' expense deductions. Still, so I want you to notice this: investors have expense deductions. This is going to be key in our conversation after the history lesson. So again, we look and so we see Roosevelt administration hoped to pay for at least half the cost of World War II, war again, by increased taxation. So every time there's a war, it gives the government a reason to increase the taxes. Now, let me ask you this question. When the war ends, do they lower the taxes? No, they don't. Right? The 1942 Revenue Act sharply increased most existing taxes, introduced the victory tax, a 5% surcharge on all net income over $624 with a post-war credit, lowered exemptions, and began provisions for medical and dental expenses and investors' expense deductions. Still, taxes only funded 43% of the war's cost, 7% short of the goal, which means they did extremely well. They did it outstandingly well on their plan, basically worked, even though it fell 7% short, right? So they had, if it was 7% short of the goal, right? I'm saying they were at what, 93% success rate? That's excellent. That means everybody bought into it, right? 1948 to 1950, right? In 1948, the Bureau introduced punch card equipment to process notices. They also introduced photocopying to reduce the typing workload and relieve a typist and stenographer storage, excuse me. In 1949, the IRS introduced electric typewriters, continuous forms, dual roller platens, and posting machines to more efficiently process income tax returns. By 1950, the Bureau introduced computers for tabulation. Internal Revenue Service created 1953. So even though they've been using the word IRS, the IRS had not been created yet. That was the BIR or the IR, the Internal Revenue. But now the Internal Revenue Service is created. This is what we know today. In 1952, President Harry S. Truman called for a comprehensive reorganization of the Bureau of Internal Revenue. The agency officially became the Internal Revenue Service 7/9/1953. Taxpayer communication and support. During the 1950s, the service primarily interacted with taxpayers through written and print communication using the U.S. Postal Service and walk-in offices. Walk-in offices or tax assistance services continue to help taxpayers today, right? Because in 1913, it became what? Federal. There was a federal tax add. In 1953, the IRS began the teaching taxes program by mailing a tax kit with teaching text. enlarged copies of tax return forms and regular return forms to 30,000 junior and senior high school principals. Why? I told you, wealth is not taught in school. Wealth is taught at home, right? This is very important. What they're teaching them is how to be taxpayers. They are creating the next generation of the highest level taxpayer. The highest level taxpayer are what? Employees working a job. So not only did they want those children to be able to work a job, but they wanted them to understand that they or believe that they had to pay taxes. In other words, this education was designed to actually make them believe that paying taxes was something that they had to do, right? At the highest level, right? And this is very important to understand because this happened to all of us. This happened to all of us, okay? By 1959, the IRS offered public service announcements to television and radio stations throughout the entire year, not just during the filing season. IRS modernizes data processing. In 1959, Congress and the Secretary of the Treasury approved IRS plans to install a nationwide automatic data processing system. By January 1962, automated data processing entered full operation, processing up to 680,000 characters per second. President Kennedy visits the IRS. He's the first president to visit the IRS. President John F. Kennedy attended the Joint Conference of Regional Commissioners and District Attorneys of IRS, the only U.S. president to visit IRS headquarters. President Kennedy praised the service for pursuing fair taxation and the promotion of national interests. Tingle Table invented. For over 50 years, Tingle Tables have saved taxpayers millions of dollars by reducing the time it takes IRS employees to sort through individual paper file returns. In 1962, James Tingle invented the table while working in an IRS service center. Mr. Tingle built the prototype in his backyard. Still in use today, over 15 million tax returns flowed through the tables during 2019 tax filing season. Taxpayer service. The toll-free telephone network system, piloted in 1966, eventually allowed IRS to handle most taxpayer inquiries by phone. On 1/1/1967, the IRS launched a nationwide automated federal tax system. That same year, the IRS established a long-range study to determine automated data processing requirements through 1970 and beyond. IRS reaches out to more taxpayers. In 1972, the IRS began to offer tax information in Spanish. Over time, translations expanded to include additional languages in print and on IRS.gov. In 1976, the service offered toll-free telephone and typewriter service. Now, why do you think they did that? Because they want more taxpayers. They want more money to be able to put what in the Social Security tax fund, trust fund, not tax fund, trust fund. That's a key word. Faster, more accurate service. In 1978, the IRS installed a remittance processing system and mail sorting system in all service centers. The system automated the sorting and opening of incoming tax returns at the rate of 22,000 pieces of mail per hour, with a 98% accuracy rate. In contrast, the top speed of the manual sort process it replaced had been 1,200 pieces per hour, right? That's how fast they can process now. Tax Reform Act of 1986. So 22,000 per hour. I wonder how many hours it runs. U.S. Congress passed the Tax Reform Act to simplify the income tax code. The service marked a pivotal change in the way it interacted with taxpayers by beginning the progression from paper-based filing to electronic filing. That was 1986, was that? Yep, 1986. 1988, service design. In 1978, the IRS studied the economic, social, and behavioral factors that impact taxpayer compliance. In 1986, the IRS established an artificial intelligence laboratory as part of an innovative initiative to explore potential applications of new technologies to tax processing. In 1988, the IRS revised its Understanding Taxes program for high school students to include computer software and video programs in the instructional materials, right? Because at that time, we were what? going into the computer age. And to keep the attention of those students, they needed to stay in alignment with it. Taxpayer rights. In 1988, the IRS published Publication 1, Your Rights as a Taxpayer, which required the IRS to fully inform taxpayers of their rights as a taxpayer and the processes for examination, appeal, collection, and refunds. Right? Taxpayer rights. E-File came out in 1991. Right? IRS Bulletin System Board, the National Technical Information Service, established FedWorld in 1992 to serve as the online locator service for an extensive inventory of information distributed by the federal government. 2 years later, in 1994, NTIS launched a bulletin board system to support the IRS, giving the service the ability to provide forms and publications online. Digital Daily. The Digital Daily was the first presence of the IRS on the World Wide Web. It had a warm and humorous tone. Humorous tone and a design that resembled a newspaper. The site grew and evolved into irs.gov, which had more than 609 million visits in 2018. So now you can do everything online through irs.gov, right? Restructuring and Reform Act of 1998. The IRS Restructuring and Reform Act of 1998 prompted the most comprehensive reorganization and modernization of the IRS in nearly half a century. The IRS reorganized itself in 2000 to closely resemble the private sector. Now, pay attention to that. That's a key point. That's a high point right there, right? That is a high point. That is a very high point. I want us to get that, right? So I want us to be clear on what it's saying. The IRS reorganized itself in 2000 to closely resemble the private sector, each aligned to a group of taxpayers with similar needs, right? And so what do we start seeing around this time? I believe it was around this time. Might have been a little bit later, but around this time, we're going to start seeing what? Social Security disappear, right? We're going to start seeing your retirement accounts being Roth IRAs, and 401ks, right? They were having this conversation was starting around this time. Most people weren't moving into those instruments until later, but the talk of that Social Security being defunct was in that conversation was coming. Digital tools for taxpayers. The IRS leaned into digital innovation, launching multiple tools: withholding calculator, where's my refund, free file, taxpayer local assistant, and sales deduction calculator. Online payments. To keep up with digital demand, the IRS introduced 2 applications that allow taxpayers to pay their bills online. This made sure everybody could pay, right? Let me see, what's this 2013? Online payment agreement, electronic installment agreement, and online payment agreement. Direct pay. The IRS worked with the Bureau of Fiscal Service to launch the first online method for federal tax payments that allows users to quickly pay without pre-registration. They could get their money faster. Digital tools for tax professionals. In a continued effort to move toward a paperless filing process, the IRS launched digital solutions for tax professionals, right? So now the tax professional could do it electronically for you. And then the IRS Student Aid Tool. The Department of Education and the IRS collaborated to build a tool that enables students and parents to transfer tax information from the IRS directly to their free application for federal student aid. IRS goes mobile. We see that. Taxpayer Bill of Rights. In 2014, Commissioner John Koskinen and taxpayer advocate Nina E. Nelson released an enhanced Taxpayer Bill of Rights. Written to be clear, understandable, and accessible for both taxpayers and IRS employees, the updated document grouped the dozens of existing rights in the tax code into 10 fundamental rights. The Taxpayer Bill of Rights is displayed in IRS offices across the country as a reminder that respecting taxpayer rights continues to be a top priority for IRS employees. Yeah. If you believe that, I got a bridge in New York that I want to sell you right now. Tax Design Challenge. IRS hosted its first crowdsourcing competition that encouraged innovative ideas for taxpayer experience of the future. Of 48 submissions, winners from California, Minnesota, and Washington, D.C. were among those selected in categories covering overall design, taxpayer usefulness, and capabilities. Online account. IRS launched online account in 2016, a self-service application that allows taxpayers to check the amount they owe, see their payment history in the last 2 years, view a snapshot of their most recently filed tax return, and link to payment options for full transcripts. IRS.gov redesigned. Tax Cuts and Jobs Act. Let me see this. Let me go back one. Tax Cuts and Jobs Act. On 12/22/2017, President Donald J. Trump signed into law H.R. 1, known as the Tax Cuts and Jobs Act, the most significant piece of tax reform legislation in decades. Today, the IRS continues its mission to provide America's taxpayers with top quality service by helping them understand and meet their tax responsibilities and enforce the law with integrity and fairness to all. IRS social media. So now they're on social media because they have to reach what? The next generation of taxpayers, right? New 1040 as part of the larger effort to help taxpayers, the Eternal Service. The IRS rather streamlined the Form 1040 into a shorter, simpler form. In 2018, the IRS released a redesigned form and 6 accompanying schedules for taxpayers with more complicated returns. This new Form 1040 retired the use of the 1040A and 1040 Easy for the taxpayer 2018. Criminal Investigation Centennial. In 1919, the Treasury Secretary asked the IRS Commissioner to form a criminal investigation unit to go after tax cheats and other criminals. 100 years later, criminal investigation special agents continue to bring down the most notorious criminals. CI remains the only law enforcement agency authority to investigate tax crimes and has earned the reputation as the premier financial investigation unit in the world. And I got a question on whether this is literally a law enforcement agency or not, if it's truly law enforcement. Could be, but I don't know. So that is the end of that. And if you notice, where do they want to end you at? Even though they're talking about 2019, 1919 is when this was formed, but they didn't bring this up in 1919. They waited until the last portion of this timeline, right, in order to bring it up because they want to instill fear in you. That is its purpose. That is why it's the last thing in the timeline. And so we don't want to live in fear. Remember, we were doing, I don't know if you've been on our calls when we're doing Rich Dad, Poor Dad, but if you were on the calls when we were doing Rich Dad, Poor Dad, then you understand that they're not really talking about the, about, we were talking about fear, and you can't make any choice based in fear, right? You can make no choice based in fear. If you're making your choices based in fear, you've already lost. So now we have to have the information, right? We have to have the proper information to make the most intelligent choice. So we have to put our fear and emotions to the back burner. And now we have to use logic and reasoning for the moment to make the proper choice and make sure that that is in alignment. Now we will reduce fear. We will remove fear. We will remove anxiety and all of those things because we will understand the truth of the matter, right? And so now what we're going to do is we're going to move to the next section of this. We got the history, right, of tax. Now what we want to do is we want to look at and understand how does this apply to us, because this means absolutely nothing. It's just a construct. It's just a form that we live inside of, right? But you now need to understand how this affects you and why you're paying as much tax as you're paying, and how you can legally, ethically, and morally reduce your taxes down to 0%, right? Like the wealthy do. So this is a financial what? Literacy workshop. So we're going to get literate. So the first thing we have to do is understand the history. Once we understand the history, now we can look practically at what this means for us, right? So now we're going to move into the practicality of this, right? So the first thing I want to do is I want us to look at this word evasion. Remember, I wanted you to write that word down. And again, if you haven't already, share this with everybody you know. Share this, share it on your pages, share it everywhere, right? Don't leave anybody out. Okay. So, how to legally avoid paying taxes. This is an extremely important portion of this we're about to go over now, right? So, how do we legally avoid taxes? Important. Learn how to lower your tax bill legally. Hang on to more of your hard earned money come tax season and do so by playing by the rules. In other words, you're going to do this in a manner that is going to cause no issues with you and the IRS. This is the key, but you're not going to do it. You can do it if you want to, but I advise you to use our experts to do it. I advise you to do that, right? Because experts are going to perfect it. And that's what I want. I like perfection. Whenever I deal with anything, I like perfection. And so that's why if you watch my video, Mr. Dummy learned, and I'm Mr. Dummy. I was Mr. Dummy. Mr. Dummy learned the hard way. Yo, get the experts when it comes to different areas of the things that you want to do. Don't do it yourself. All wealthy people, the reason wealthy people are wealthy is because they learned quicker than the average person. For every area in my life, I'm going to have experts. I was listening to Steve Harvey today. Steve Harvey, the first thing he was talking about his health and how he had a problem. The first thing he had around him was a team of experts helping him with his health until he found the answer. He's going to have a team of experts. All wealthy people understand this concept of expert. If you talk to middle class and poor people, ask them, do they have a team of experts? And they're going to say no. Talk to all wealthy people and ask them, do they have a team of experts? And they're going to say yes. In every area of my life, I have an expert. I have a trainer for my gym. I have this for that. I have financial advisors for this. If I'm going into business, I have business partners that I can rely on for information. And we as a team pull another team of experts as an advisory board in so that we have another team of experts. They always have experts. We have to stop running from that and start embracing teams of experts so we can get the best result for what it is we're trying to do fast as we can, right? Exponential results or expedited results. Now, I'm going down here. Tax avoidance versus tax evasion. I want us to look at that. I want you to write those two terms down. Tax avoidance versus tax evasion. Those are two different things. But you've never heard of tax avoidance, have you? You never heard of that. You've only heard of tax evasion. Why? Because tax evasion will put you in jail. So if I want you to pay taxes, why would I ever tell you about tax avoidance? I would tell you the negative things that happen to people that evaded taxes. I would never tell you about the positive things that are happening to people that are avoiding taxes. Right? So the term tax avoidance sounds a bit sinister, but it isn't the same as tax evasion. One's legal, tax avoidance is legal, and one isn't. Tax evasion is illegal. As long as you're playing within the rules and aren't hiding anything from the IRS. This is a key phrase right here. Take a screenshot of this. As long as you're playing within the rules and aren't hiding anything from the IRS. It's about knowing your options to avoid overpaying your taxes. And that's what many people are doing. First, you're overpaying. The fact that you're paying anything at all is ridiculous. But most people are overpaying what they believe they're supposed to be paying. Because when you went to your job and you filled out your W-4, guess what? You're not a tax expert. So why would you be filling out your W-4? Why would you do that? Why would they even give you the W-4 and they know you're not a tax expert? Because they want to make sure you fill it out wrong so they can take out as much tax as they can. You should never be filling out your W-4. You need a team of experts filling those out for you. So again, as we state here, for more information on that, make sure you do what? Text taxes to 833-740-2315. It's very important because we're about to dig into this now. Now we're getting into some real information. This is going to be practical use for you right now, what we're talking about, right? So tax avoidance equals legally reducing your taxable income by using deductions, claiming credits, and investing in tax advantage accounts as allowed by the U.S. tax code, right? So this now you're allowed to do these things, right? This is key. Tax evasion is concealing information about your financial situation from the IRS or other tax authorities, such as your CPA. So if you're hiding the money that you're making, now you're evading taxes, right? So you're trying to say, I'm not going to pay these taxes. I'm going to hide and not let them know that I'm making this money. So what we advise is that you're an open book, but that you pay zero tax. So now you're avoiding taxes legally, right? Which we'll get into more in depth in a minute, but we're going to go really deep into that when we get into protecting your family, right? So now you're going to be more. Now you're going to pay more or pay less in taxes. So now you're going to give them all the information. You're going to be an open book. You're not going to worry about nothing. You're going to be totally covered. You ain't going to worry about IRS anymore. Everything is going to be perfect, and you're going to pay zero tax legally, ethically, and morally. Tax evasion, concealing information about your financial situation from the IRS or other tax authorities, such as your CPA. You cannot do that. Do not do that. Don't do that. Get with the experts that we're sharing, that we will share with you. Get with those experts, I'm telling you, and let them properly make it where you don't have to pay any tax. Let's walk through that process together. And we're going to talk about that in a minute. That's the next phase of this, okay? To understand where you stand and where you want to be, okay? So tax avoidance is about knowing the rules so you can keep more of what's rightfully yours. Tax evasion involves lying, hiding, and failing to report money that you owe, which is essentially stealing. Before we break down some good ways, I don't agree with that, but that's what they're saying. Before we break down some good ways to legally reduce your taxes, let's clarify what's not legally acceptable so that the difference between the two is a bit clearer. Examples of tax evasion. Tax evasion occurs when someone conceals or distorts their financial situation to pay less tax. This is illegal and can lead to hefty fines and worse. This can include not reporting cash income, not reporting overseas income, not reporting cryptocurrency earnings, claiming personal expenses as tax deductible business expenses, asking clients to make checks payable to your personal account, and not recording them as a business payment. Take a picture of that. Know that. This is good. This is excellent. Right, family? This is excellent. So 6 ways for business owners to legally avoid or reduce taxes. This isn't fully exhaustive, meaning this ain't the full list. There's over 470 tax deductions that a business can take. It's not the full list. So I want you to understand these are 6 of 470 ways you're able to get rid of taxes. Actually, more than that, even because that's just for business. We ain't even going to investors and trust, right? So we're going to talk about that in a minute. So, self-employment tax deduction. The standard self-employment tax for business owners, independent contractors, and freelancers is 15.3% your net earnings after business expenses. You're down to 15%. So the average person is paying 28 to 37% in tax. 28 to 37% if you got a job. And we're going to talk about that in a minute. We're down to 15%, right? Average, right? Sometimes it can be higher. It can be a little higher, up to 18%, I think it is, right? Around 15 to 18% of your net earnings after business expenses. This covers your Medicare and Social Security contribution. The IRS considers half of this tax to be business expense, which means you should calculate your self-employment tax off 92.35% of your net earnings by removing half of your self-employment tax, 7.65% from your net earnings. You make sure you don't pay taxes on money you will deduct down the line. I don't do that. You know what I do? I hand it to the experts and let them do that. That's what I do. And I don't have to pay taxes. I've not paid taxes due to the fact of this. Right? And when I had to pay taxes, it was very inexpensive because I'm following this system. Right? Deduct 50% of what you paid in self-employment tax from your net earnings when you calculate your taxable income. Right? Deduct for business expenses. Savvy business owners take full advantage of business expenses that can be deducted from their income when filing taxes. This includes things like home office deductions, phone bills, and internet, raw materials for your craft, marketing and advertising costs, office supplies, client meetings, business trips, education related to your field, and more. A detailed list of deductible business expenses can be found on the IRS website. I don't do that. I let the experts do it. I never tried to do this. I let experts always do it. Some people, they might want to play that game. I don't. I let experts handle that. That was one place I was wise. I wasn't Mr. Dummy right there. Right? Contribute to a retirement plan. Uh-oh. We're going to talk about some other things, but they're going to say IRA. These are what they're going to tell. I told you. They're only going to give you instruments that they want the average person to know. But we're going to go to another level. We're going to get into some instruments that the wealthy know. This is a smart way to reduce your taxable income while simultaneously investing in your future. There are a few options for freelance retirement accounts, such as Roth IRA, SEP IRA, or SEP IRA, and a solo 401k. We don't want to put anything into any of them, possibly a Roth IRA. And I'll explain to you why in a minute because we're going to talk about it. Contribute to an HSA. This is about using tax-free savings to cover medical expenses such as doctor visit, co-pays, deductibles, and even specific items like prescriptions, contact lenses, dental, and vision care. And if you remember, that was implemented early, I believe in the 1800s, might have been the early 1900s, but I believe it was the 1800s, where they allowed dental and doctor visits and all that as deductions right after they induced or offered the first tax deductions were allowed, right? This is ideal for people who are relatively healthy and aren't likely to get sick since the deductible is higher. However, you have lower monthly premiums in an HSA where you can transfer pre-tax income. Remember pre-tax income, very important. Pre-tax income. Donate to charity. In 2022, taxpayers must claim charitable contributions as itemized deductions on Schedule A of IRS Form 1040 under gifts to charity, as the 2021 charitable tax deduction rules were not extended. So it's important to ask for a tax receipt anytime you donate clothing, make an online donation, attend charity event, virtual or in person, as these are all tax deductible. Even volunteering expenses like gas mileage can be included, right? Child tax credit. For business owners with children, the child tax credit represents a further opportunity to reduce their taxes, as the 2021 enhancements to the CTC has expired for 2022. The initial tax credit is $2,000 for each qualifying child. As well, a child must be under age 17 at the end of the calendar year, right? So here's what I want you to do. I want you to understand, if you notice, most of these tax, like, in order to save money on taxes, the first thing that they're talking about having is a business, right? Business ownership is key, right? So it doesn't matter what business you're in, business ownership is key. That's why we always promote business ownership. You're going to, even if you have a job, you want to have a business over here. Everything you do in that business is a write-off. You're going to get more than you even can imagine on your taxes, right? Your returns. Now, let's deal with that. So, let's look at the 4 quadrants. It always brings us back to these 4 quadrants, right? The cash flow quadrant, Robert Kiyosaki's program. I love this because it breaks everything down perfectly. So the employee is going to pay the highest in taxes, 37% to 28%, to 37%. So if you're a person making $100,000 a year, that's $28,000 to $37,000 in taxes that they're taking out of your check. We asked the question, what is your biggest bill? Most people think it's their mortgage. No, it's not. It is your taxes. You get they're taking taxes out of your check. You got to pay taxes when you go buy food and all of that, or any products. Taxes is your highest bill, period. It is. There's no way around dancing around that. So taxes is the highest bill. We have a system, right, where our experts will look at, or is able to get where your taxes are coming back to you every check. In other words, we give people what is called an instant pay raise, where the experts will look at your W-4, correct your W-4, and now every single paycheck, we're increasing people's paychecks anywhere from $50 all the way up to $500 per paycheck. $50 to $500. Can you imagine the extra $50 to $500 per paycheck coming in? Why do we do this? Because the government is taking that money and doing what they want with it, investing it, flipping your money over and over again. What we're saying is, why don't you take that money and utilize it and flip it over and over and over again, right? And when we dealt with our cash flow yesterday, right? When we dealt with it, we were talking about you want interest. Well, that would be more cash flow. Just imagine if you got this $800 coming in per paycheck, but now instead of $800, you got $1,000 or $1,300 coming in. What would you do with that extra $1,300 coming in, right? Or that extra $500 coming in every month? You're going to put it into an interest-bearing account, right? That's going to give you a return on interest. If you missed the workshop from yesterday, Understanding Money, make sure you watch that workshop. That is an extremely important workshop. Okay. So make sure you get the Understanding Money workshop. Okay. That is very, very important. So watch that. That'll be on the YouTube live tab, right? Or you can get it in Facebook as well. But it'll be Understanding Money. Workshop 1, Understanding Money. We went deep into this and we walked through this process of understanding this chart. So I'm not going to go back through this chart again and understanding it. I just want you to understand, what would you do with that extra cash flow coming in, right? So now we're going to move back to employee, right? So as an employee, you pay the highest amount in taxes, 28 to 37%. As a self-employed, you're going to pay about 18%. They said 15.3, but it's going to be about 18% here. That business owner that owns a business system like corporations, or if you're in network marketing, you're going to pay a lower amount. We can get you down probably about 15 to 7 to like 10. Really about 15. Somewhere around 15 would be normal here. Here would be higher, right? It will be higher there. So that's going to be more so around 18 to 22%. here, 18 to 22%, and probably around 15% about right here, right? Now, where you want to get to on this chart is the investor. The investor, now you can get your monies down to 10 to 15%. Why? Because now remember they were talking about pre-tax dollars. You can either defer taxes as an investor, or we have accounts, right? The wealthy investing accounts that have zero tax. It cannot be taxed, right? So investors, the wealthy investors, these are above average. Wealthy investors, they're able to tax. For that. They're able to put their money in places where it will never get taxed. Okay, even when you pull out. Now we're going to talk about what the average person uses, right? The average person is in what's called a 401k. And the 401k is basically a plan where you determine what stocks or what type of stock profile you want inside of the 401k. If you know what you're doing, you could put your own stocks in there, the exact stocks you want. But most people, they allow their broker to, they'll say, what type of stocks are you interested in? And then they'll just grab a collection of them that they choose and put them in there, right? But it is based on the fluctuation of the market. If the market goes up, it is worth more. If the market goes down, it is worth less. And we know we're about to come into a crash right now, right? So that's going to go up and down, right? Now, employee contributions to a 401k plan and any earnings from investments are tax deferred. What does that mean? That means when you withdraw the money, right? When you withdraw the money, then what happens is you're going to be taxed on that money at that time. Well, if I'm younger and I know that taxes traditionally go up, not down, right? Remember when what's his name? The president Bush won, right? Bush won when he said, "Read my lips, no more no increase in taxes," right? Please, taxes went up. That's what he got attacked for, because his word was garbage on that statement. So taxes are going to go up. So do you want to pay taxes now or later? You rather pay them now than later. But in a 401k, your taxes are being deferred until a later date. So you pay taxes on contributions and earnings while the savings are withdrawn. As a benefit to employers, some employers will match a portion of an employee's 401k contributions. I don't advise a 401k even if you're getting the match. A match is good, but not a 401k, right? Okay. Now we have the traditional IRA. Your money can grow tax deferred, also tax deferred, but you'll pay ordinary income tax on your withdrawals, and you must start taking distributions after age 73. So they force you to start taking money out of a traditional IRA after you turn 73. Unlike with the Roth IRA, there are no income limitations to opening a traditional IRA. So you can put as much money as you want into a IRA. But a Roth IRA, you can't. And here's why. Because they don't care how much money you put in here, because they can tax it. But a Roth IRA, with the Roth IRA, individual retirement account, you save and grow your retirement investments tax deferred and pay no tax on withdrawals after you retire. That's the good thing about a Roth IRA. Now, am I saying to invest in a Roth IRA? No, unless your employer is matching what you're putting in it. The main problem with a tax with this program is that maximum contributions, if you come down to this portion here, let me highlight that, so because I'm skipping. Maximum contributions in year 2021, the most you can contribute yearly is $6,000 or $7,000 if you are age 50 and older. Now, I want you to understand this. I want you to hear this. That's every year. The most you can put in a IRA, a Roth IRA, is $6,000 to $7,000. And if you have multiple IRAs, they have to be combined 6,000 to 7,000. You can't go above 6,000 to 7,000. Even if I had 10 of them, I could only put up the max 700 a piece in them per year. So they're doing that on purpose because they know it can be tax deferred. Well, our experts have found legally, ethically, and morally accounts that you can put unlimited amounts in, receive more return than you would on an IRA or a Roth IRA, which a Roth IRA gives you a 7 to 10% on average, but it's attached to the stock market up and down fluctuation. So again, it's risky, right? And this is your retirement. We ain't talking about something you playing with. This is after you can't work anymore. You can't make any more money. This is what retirement is for. So if that is attached to a stock market and the stock market drops and you have a Great Depression, your money is gone. You have no retirement. So that's why we're talking about no risk instruments that you can put your money in that will give you anywhere from 5 to 30% return annually. That when the market goes up, it goes up. And when the market goes down, it stays flatline. In other words, you get paid wherever you left off. So it doesn't go down with the market. So they're secure. Your retirement is secure. And when you pull the money out at any time, whether you're retired or not, it's not taxed. That's extremely powerful. So if you, again, for more information, text taxes to 833-740-2315, right? Text taxes to 833-740-2315. It's very important. Okay. Now, this is key right here. So these are what the employee uses, right? The average person. Okay. So now you put that money in there, but it's going to be tax deferred. But we want untaxable, right? Right. So as an employee, we can now get you non-taxable, no risk, high yield, interest bearing accounts, high yield. So if we come back to our chart over here and we put in here high yield, I'm just going to use that term, high yield, no risk, right? Accounts, right? We're in accounts, high yield, no risk. And let's say instead of this CD at 3%, we put this 300,000 inside of an account that's giving us 9%, right? We take this out the CD, we remove it from the CD, right? We take it out of here. And now we put it in here, high yield, no risk. And we put that 300,000 in here at 9%. Now we're at 27,000 yield per year. Where before we were at what? We were at 9,000, right? I'm sorry, I'm leaving off a zero. We were at 9,000. So instead of 9,000, we're at 27,000. But let's say this went up. Let's say this went up to 19%. We're at $57,000 per year off the same money. What if it hits 30? And remember, you can't go down once you hit it. So now what if it hits 30? You at $90,000 per year coming in as untaxable money, legally, ethically, and morally. These are the type of accounts we're talking about. This is the difference that it will make. Now, can you live off of $90,000 a year? Can you live off of $27,000 a year extra? And you're building this account more and more every single week. When this money comes in, you don't even have to touch your money anymore because your interest is covering it. Your interest is covering everything. So your goal is to fill these high yield, no risk accounts, which as much money as you can, so you can get the interest. And we're not even dealing with compounding, because this is going to compound every year. Right? So I want you to understand the power of what is in your hand, or the opportunity that's presented before you. I would advise you to take advantage of it. Now, self-employed. The self-employed is going to get anywhere from, it's going to, like I said, 18%. We're going to get it down. Investor. We just dealt with investor, right? But now, after that comes something very important here. And that's what we're going to talk about in our next meeting. I mean, not our next meeting, but when we get to family, protect your family. And that's trusts. A trust properly developed in the right jurisdiction. And I advise you to really come to that protect your family. Is going to get you down to 0%, 5% to 0% tax. So if you're making $100,000 a month, and now you get that extra $37,000 or $27,000 to $32,000 a year that you can throw up in here, you understand, and let that grow, and let it grow, and let it grow. You will be wealthy, right? Instead of a 20-year and 50-year programs, you'll be wealthy within 5 to 10 years. We have sped up removing people's debt, as well as their retirement dates, by 15 and 20 years. So I want you to understand the power of what we have in our hands. Okay? And the key thing that I want you to get is, we don't want you to go to work because you have to. We want you to go to work because you want to. If you choose to keep your job, we want you to go to work because you want to, not because you have to. And too many people are going to work because they have to, because they simply do not understand what we have available to them. And so with that, I'm going to open up. If anybody has any questions, please type them in the chat. If not, we're going to go ahead and close out. Okay. So here's a question that came up. Can we transfer all retirement accounts to MWR experts without being penalized? I don't know the answer. Like I said, you already got your sitting. I'm not the expert. I'm sharing information to get you in contact with the experts. You should have your sitting coming up, so you need to ask them. I can't answer that. I know you can transfer all your retirement accounts, but without being penalized, I'm not sure. I haven't worked a job probably since I was about 20 something. So I don't have any retirement accounts like that. I don't have those type of accounts. So I'm going straight pure in for me. So that's a excellent question. Do we have any other questions on anything that was stated tonight? If there's no other questions, I appreciate everybody's time. I pray you got a lot out of this. How was it for everybody? Did everybody get a lot out of it? If so, type in if you can. if you can. All right, great. Anyone else? All right, I appreciate that. Yeah, it is. Knowledge is power. That is the truth. All right, everyone, then. I appreciate your time. And so, with that, that will close out. I will see you all at the top. I love you all with a perfect love, and there's nothing you can do about it. Peace. Oh, yes, one more thing. Do not forget on Friday, we will have ding, 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 ding. We will have our next, uh, let me make sure. We will have our next workshop this Friday. Become your own bank at 3 o'clock p.m. Central Standard Time, 4 o'clock p.m. Eastern. Make sure you do that and you're there as well. And then again, for more information on this one, text taxes to 833-740-2315. If you're ready to get an instant pay raise, if you're ready for the experts to fix it so that you can get an extra 200 to $2,000 per month on your check every single month. Text taxes, or if you just want more information on how to set up your business properly in order to receive the taxes, or if you want to definitely start moving forward in being able to have non-taxable accounts. Okay, so or retirement accounts or regular accounts as well. We do both. And so if you are interested in those, please again text taxes to 833-740-2315 or get back with the person that invited you here tonight, and they'll be able to get you in touch with someone that will be able to help you in that arena and then get you to the experts. Okay, so I appreciate everybody's time. Thank you so much and have an outstanding evening. Peace.